Hey, Saretsky here. Welcome back to the show. I want to touch this week on Canadian bank earnings. There's some interesting information here that I think is going to paint a picture of what's happening in the Canadian housing market. And I think this is all leading up into, the discussions around the Bank of Canada, which is coming out with a rate announcement next week, GDP, etc. Some big picture, high level stuff, because we have to kind of frame it up and say, it's really been interesting, right? Like we had, this highly levered Canadian housing market. And then during the pandemic, things got even crazier, right? Off of zero interest rate policy. Then all of a sudden we go raise rates by 500 basis points, the fastest rate hiking or tightening cycle in modern history when you adjust for the levels of indebtedness in the country. And you look at the Canadian housing market, you go, wow, it's pretty much relatively unscathed. It's surprised myself. I would say it certainly surprised a lot of the YouTube doomsdayers that are in the comments section here. But there's some interesting information, and we can see that in the Canadian bank earnings to say, well, hold on a minute. We haven't had a crisis yet, but it's not to say that you can't have one moving forward. There are still a lot of issues underneath the surface, and that's really what I want to highlight here today as you comb through the Canadian bank's earnings. And so you have to frame it up and say, as of today, about 50% of all the mortgages that are outstanding in Canada have not yet seen a mortgage payment increase. Because again, a lot of people are on fixed rate mortgages. They haven't come up for renewal yet. But there is a cohort of mortgages out there, roughly 50% at this stage, that have either been on fixed rates that have come up for renewal already, or they're variable rate mortgages that have seen some payment increase. And again, when I say some, it's because we have these products in Canada, these variable rate product mortgages, where, 4 of the big 5 Canadian banks have what they call a static payment variable, which basically means that just because the Bank of Canada raises rates, right, 500 basis points, doesn't mean that your payment necessarily goes up. So what happens? Well, all of a sudden, basically, your mortgage payment, more of it, or basically all of it, goes towards interest, and you start paying down no principal. And so how does this all work? And what are the ramifications of this? Because I think it is, again, telling us a very, very important story in the marketplace today. So for example, 3 of the big 5 Canadian banks, which is CIBC, TD, and BMO, they have this product which basically allows your to negative amortize. And what that basically means is that your current payment, your mortgage payment, your variable payment, you don't even have to pay all of the interest. And so not only does your payment, let's say, just stay the same or goes up very, very marginally, you're no longer paying off any principal. And in fact, in some cases, we're seeing where you're not even paying all the interest. And so these banks are actually allowing clients to grow their balance. So the interest that they're not paying, that they should be paying, is actually adding to the balance. So the balance of the loan is actually growing. And this is what we call a negative amortizing mortgage. And so if we look at the most recent bank earnings that just came out, we can see a situation where 14% of CIBC's mortgage book is negative amortizing. At TD, it's 13%. At BMO, it's 15%. Now, I will add that number is slowly going down, but the reality is you still have a fairly significant chunk of mortgages that are negative amortizing. Now, if you look at places like RBC, their program, for example, doesn't allow you to add to the balance of the mortgage, okay? So you can't defer your interest payment. They force you to pay all the interest outstanding. So they don't have any negative amortizing mortgages. But their product, for example, does allow you a scenario where all of your mortgage payment is only interest. And so you're not paying any principal down. So what happens is, what might be a 30-year amortization, well, based on the current trajectory, could end up being a 40 or 50 or 60-year amortization. It could take you 60 years to pay it down on the current pace. And then you have Scotiabank, which doesn't allow negative amortizing because they're the only bank that has a true floating rate mortgage, which means every time the Bank of Canada raises interest rates, which pushes the prime rate up, your mortgage payment will automatically increase. So this is how this is all happening. And so there's an interesting little, I've had conversations, over the last year and a half, right? You talk to everybody in the industry, clients. That's what I do on a day-to-day living, right? And so you get these interesting sort of anecdotal stories. And so I do remember, I think I've shared on this channel before, one individual reached out to me and said, hey, I've got this investment property and I'm thinking about selling it. What do you think? And, we walk through the numbers and he says, well, I don't really like that sale price. I think I'll just hold on to it. And I said, oh, wow, you must have done well. You must have locked in your rate because, a lot of investors we're hearing from, want to sell because, their variable rate mortgages push the payments up and it no longer cash flows. And so he goes, no. Basically what's happening is I'm deferring the interest through the static variable product, and I'm adding $800 a month of outstanding interest onto the balance. So the loan is literally growing by $800 per month. But his payment is, again, staying the same. And well, that's kind of a crazy product that this is kind of allowed. And you can see a situation, right? Well, this is partially why you've had very little inventory coming to market. There's been very little stress in the market to date. Is because banks are effectively allowing people to extend and pretend. And I'll give you another, anecdotal conversation that I've had recently, which was, okay, so you think about a customer that is on one of these products again, where you're negative amortizing, right? You've gone from what was a 30-year mortgage to all of a sudden it's a 55-year amortization because they're not paying really down. They're not paying any principal down. And in fact, they might even be deferring some of their interest. And so this individual, for example, had a outstanding credit card balance. And he says, well, geez, I've got this really large credit card. And what I'd like to do is, in order for me to pay it off, is I'd like to roll it into the mortgage. And so what you can do is you can go to the bank and you can ask them to increase your mortgage, right? So this is an interesting thought process, because if this person is already negatively amortizing, which means their balance is actually growing, right? And they're not paying any principal and they're not paying necessarily all of their interest, you would think that would the bank actually give them more money? Would the bank give them more money? Would they give them a larger mortgage? Or would this be immediately shut down in the back channels? And the answer I got was no, it was approved. Despite a client that is already negative amortizing, they allowed this individual to add to the balance. And so this is really creating this sort of perverse system that is basically extending and pretending a lot of these issues. And this is why I always come back and say the reality is when you understand the industry and the business and how the real world works, is there are 5 large Canadian banks, and they run the country. It's not me, it's not you, it's not JT, it's the banks, okay? They are the issuers of credit, and they are running the country. And so this is how you basically paper over and prevent large crises from happening. Now, again, we'll wait and see how this all plays out, but it's just the crazy stories that you see, right? Remember during the pandemic, I mean, we had almost 20% of mortgages outstanding were being deferred. People were not paying their mortgage payments because the bank says, you know what, don't even worry about paying. Take a 6-month vacation from paying your mortgage and don't worry about it. So the banks can kind of just make up these rules as they go along to prevent default. The bank does not want your house. The bank does not want foreclosures and repossessing houses. When house prices come down, that impacts the collateral that the bank has. Okay, your house is the bank's collateral. So why would they want the value of their collateral, the money that they've lent you, to decline steadily and aggressively across the board? And so that's why you see these sort of shenanigans that are happening behind the scenes. And again, love it, hate it, disagree with it. It should infuriate some people. This is just the reality of the beast. And so taking this all into account, I think this is why we've seen this housing market that is basically hardly budged after 500 basis points of rate hikes. Now, ultimately, when we say hardly budged, the reality is that the economy and houses probably haven't softened enough to allow the release valve now from the Bank of Canada to start aggressively cutting rates. Tiff Macklem, let's be honest, this guy is definitely keeping him up at night of all these mortgages that are 50% of them that still need to renew into higher mortgages. And people that have to start paying an extra $1,000, $2,000, $4,000 a month for their mortgage is going to suck a lot of excess dollars out of the economy that would normally be spent at your local restaurant or grocery store or Canucks hockey game. It's going to go towards servicing the mortgage. And so this is definitely what keeps these guys up at night. And so now people say, well, what happens to all these variable rate mortgages, on renewal? Well, technically what's supposed to happen is if you started with a 30-year amortization and you signed a 5-year mortgage term, so in 5 years, when you go to renew, there should be 25 years left on the amortization. You have to then fit that remaining balance, which, again, if your negative amortizing has grown, you have to fit that remaining balance within the 25-year amortization, unless you refinance and you push it back to 30 years, which again requires you to refinance. You have to pass the mortgage stress test. So the question is, okay, how good is your balance sheet? Do you have, excess? If you have income growth over the last 3-4 years, that is going to allow you to pass the new stress test and push this back. And I would argue that even if you do push it back to a 30-year amortization, assuming where interest rates are in a year, 2 years from now, 3 years from now, you could still be stuck with a decent size payment increase. So this is the problem that I know the Bank of Canada is worried about. Is Tiff Macklem came out, about a year ago and said, listen, we need to get interest rates up quickly and aggressively in order so we can then bring them back down. So the quicker that we get inflation under control, the quicker that we can then reduce interest rates and alleviate what this problem looks like down the road. And the problem is that you're now 2 years into this, and it's not overly convincing that inflation is under control. It seems that there hasn't necessarily been enough economic damage to really bring in, let's say, a deflationary type of impulse. And so, that's why you're starting to see is that markets are starting to push rate cuts further and further out. And so, what used to be, I think, coming into this year was there was an expectation at the end of 2023 that we'd get 5 rate cuts in 2024. Well, the market has now kind of repriced that. Now they're only expecting 3. And in a month or 2 months, it could only be 2. And so, you're then wondering the situation that maybe in 2025, next year, maybe mortgage rates are still with a 5. Maybe they're 4.5. Are we going to have problems with people renewing at, another wave, another chunk of mortgages renewing at 4.8? So this is kind of the give and the get on both sides. And we're going to see how this all sort of starts to shape up. And, it is funny, right? Because I wouldn't say it's funny. It's actually kind of concerning. Is the reality is that, people that are saying, they're renting, they're saying, you shouldn't have bought a house. It was a bubble. You shouldn't have bought into it. You're not avoiding this either in the rental market. The rental market is just as bad. Think about turnover rents, right? You're renting you're renting a condo from a landlord. He says, oh my God, I can no longer afford my variable rate mortgage. What happens? He puts it on the market to sell, and then you get the eviction notice and you're out. And then you're at the mercy of the new market rental rates, which according to CMHC, which just put out a report, turnover rents, they went out and they said, okay, let's measure turnover rents for privately owned units. So not like a purpose-built building, but let's go measure the turnover rents for private dwelling units. So they measured 2-bedroom turnover rents in all these major metropolitan cities, and the increase on turnover rents just for 2023 in Vancouver was 33%. So what they're basically saying is, like, if a unit, what is the average of the units that turned over? So you had a tenant in for 4 years, Maybe they voluntarily left, they got a new job, they relocated. You had a tenant in there for 4 years. That unit then turned over, right? It got re-rented to somebody else. What was the increase? So the increase was 33% in Vancouver. In Toronto, it was 40%. Okay, so whether you're renewing your mortgage today or you're getting evicted and moving into a new rental, you are succumbing to a significant increase either way of shelter costs. And so this is passing through the market. I mean, you have to start paying 40% more on your rent. You're going to have to start cutting your expenses somewhere else. And again, I think that's in the real economy. And I think this is why we just saw real GDP on a per capita basis here in Canada has been declining for 6 consecutive quarters. Again, we haven't officially declared a recession. We'll wait for the statisticians to revise the data 18 months from now. But for all intents and purposes, if it feels kind of recessionary today, it's because on a real per capita basis, GDP has been declining. And that is why people genuinely or generally feel a little bit worse off. And again, I don't think you're escaping. You're not escaping the inflationary environment in housing, whether you're owning or you're renting. And so I think that's important context for this week's video. Let's wait and see. But again, you have to sort of think that these increase in shelter costs, the cost to put a roof over your head, hitting everybody is going to continue to suck money out of the real economy elsewhere. So that's kind of what I'm watching. Keep an eye on the banks report earnings moving forward, and keep an eye on Tiff Macklem, our buddy Tiff, next week at his interest rate announcement. We'll see what kind of tone that he comes out with. As always, see you next week.